Money laundering is changing faster than most people realize, and over the last couple of years, criminals have started using new methods that are looking nothing like the typologies that we've learned early in our career. So today I want to walk you through the top 10 emerging money laundering schemes that regulators, investigators, and financial institutions are now dealing with around the world. So these aren't theory, these are real patterns identified by bodies like FATF, FinCEN, Europol, and the US Treasury. And if you work in AML or you aspire to work in this field, this is exactly the kind of insight that can help you to stay ahead. So let's jump into today's video. Let's start with something that exploded globally, crypto mixers. Criminals sell illicit crypto into mixing services and it gets pooled with thousands of other deposits and the output becomes almost impossible to trace. In 2022, mixers processed around 7.8 billion US dollars and a quarter of that came from illicit wallet. And in the same year, the US Treasury even sanctioned Tornado Cash after discovering that it was used by North Korean cyber groups for them to launder stolen funds. So yes, mixers have become the new digital laundromat. Next, decentralized finance. This is my number 2 on the list. The DeFi platform, smart contracts, and cross-chain bridges are being used to move value between blockchains instantly, anonymously, and without touching a regulated exchange. Fincrime found that ransomware actors launder more than 50 millions US dollars using cross-chain bridges in just the first half of 2022. And think of this as chain hopping on steroids, a brand new challenge for investigators. Number 3, AI-assisted laundering and synthetic identities. AI has entered the world of money laundering. We know that, and we've seen AI-generated identities, deepfakes, selfies, and synthetic identities passing onboarding checks at bank and fintech. So these fake personas open accounts, move money, and close them before anyone even notices. And FinCEN reported a sharp rise in SaaS involving deepfakes, media that are used to circumvent KYC verification. This is no longer science fiction. As you have seen, criminals are automating parts now of the laundering process. NFTs have created a perfect environment for wash trading in money laundering. And how does it look in practice? You essentially have criminals minting or buying an NFT and then selling it to themselves at, of course, different wallets that they control with an increased price. On the blockchain, it appears as a series of independent sales and fast price appreciation is taking place. But in reality, it's just the same money moving in circles, so it can be later claimed as legitimate art income. A legal analysis by international law firm Garrigues, drawing on blockchain data from Chainalysis, is describing wash trading in the NFT markets as a transaction in which the seller and the purchaser of the NFTs is the same person in successive transactions, exactly as you described. So according to the figures cited, a group of 110 NFT owners generating about 8.9 million US dollars in profit from this kind of wash trading. Classic behavior for both price manipulation and potential laundering. So digital art has effectively become a modern luxury asset that criminals can use to disguise the origin of funds in a fast, cross-border, and highly speculative market. One of the most creative laundering channels that are emerging now is online gaming. In-game currencies, virtual assets, rare items, criminals buy them with dirty money, move them around from multiple accounts, and cash out on the gray market. This is still highly non-regulated, which is why it's becoming attractive to them. Studies have shown that billions flows through virtual worlds like Second Life and modern games now have even more complex economies. So there is also a dedicated video on this specific issue that I've recorded over a year ago now. So if you want to find out more about this specific topic, I will leave you a link up here. But in summary, if your bank isn't monitoring gaming related transfer, this is now a gap that you want to watch going forward. Before we explore the 6th emerging money laundering scheme that is on my list, if you're building a career in AML or you want to move into investigations or sanctions role and you want structured guidance, practical examples, and a clarity on the career paths that are available out there, check out my Fincrime Career Accelerator. You will find the link right here and also in the description of this video. This is literally a fantastic course, so please do check it out as it can help your career going forward. And now we can move to the next money laundering scheme item. Now let's talk about fintechs. Supervisors in the UK and other regions have highlighted that some fast-growing challenger banks and fintech showed weaknesses in customer due diligence and transaction monitoring during rapid expansion. So these gaps created opportunities for criminals to open and exploit mule accounts, especially in environments with streamlined digital onboarding. So numerous supervisory reviews across Europe and the UK have made this priority area for remediation. And this matters because criminals follow the path, of course, where there is least resistance. When onboarding is fast, transfers are instant, and controls are still maturing, fintech app can become ideal tools for layering funds at speed. This is a reminder that innovation brings amazing benefits. I'm very up for innovation, but it also creates openings that financial crime teams must close very quickly. Real estate has always been a classic money laundering method, but now it's evolving into tokenized real estate. This means criminals can buy fractional digital shares of property using crypto, high ownership behind wallet, and then sell those tokens later as legitimate investment proceeds. Several regulators bodies, including also FATF, have warned that the tokenized asset must not become AML blind spot. And again, we should be addressing this at the onboarding level. If platforms don't verify the real beneficial owners behind the tokens, criminals will step in. Trade-based money laundering, TBML, is back in the spotlight and more sophisticated than ever. We've seen complex cross-border operations involving misinvoicing, phantom shipments, over and under valued commodities, multiple shell import-export firms. Again, a few videos are already available on my channel on this, so check up here. US authorities have highlighted the growth of Chinese money laundering networks that use mirror transactions, shell companies, and underground banking to move cartel proceeds across borders. Their methods were outlined in a recent Treasury communication describing these networks as highly structured, globally connected, and capable of moving large amounts of illicit funds while avoiding the traditional banking system. A major trend in recent years is the rise of professional money laundering networks. These groups operate chains of shell companies across multiple countries using nominees from businesses and underground banking to hide ownership and move funds without leaving a clear trail. For financial institutions, the challenge is that these structures often look like legitimate companies. Only when you zoom out, you can see the pattern that is becoming visible. Circular ownership, rapid cross-border flows, and accounts with no clear commercial purpose. Finally, another emerging trend is the misuse of charities, non-profit, and ESG-themed organizations as part of money laundering schemes. These entities naturally carry a sense of trust and social value, which means Transactions flowing through them often attract less scrutiny, and criminal networks exploit this by setting up organizations that appear to support environmental projects, conservation efforts, or community initiatives, while quietly using them to move or disguise illicit funds. Donations, grants, or projects-related transfer become the story that explain the money, even when the underlying activities is minimal or completely fabricated. For ML professional, this is a reminder that legitimacy on the surface doesn't guarantee legitimacy underneath. So even organization with positive missions can be repurposed and laundering vehicles when control, governance, or oversight are weak. So here is a quick recap of the top 10 emerging money laundering schemes that we listed today. Crypto mixers, pooling illicit crypto with thousands of other deposits to break traceability. Number two, DeFi cross-chain laundering, moving value across blockchain instantly through bridges and smart contract. On number three, we had AI-driven synthetic identities, deepfake IDs, and AI-generated person slipping through the onboarding phase. Number four, NFT wash trading, self-buying digital arts across multiple wallets to disguise illicit funds. Number five, online gaming currencies, using in-game items and virtual assets to layer and cash out illicit monies. Number six, we had fintech layering via P2P apps, so rapid transfer and lightly governed onboarding exploited for mule activities. Number seven, tokenized real estate, buying and selling a fractional part of property tokens to anonymized owners. Number eight, trade-based money laundering with misinvoicing, phantom shipment, and commodity manipulation across border. In number nine, we had professional shell networks, large multiple jurisdiction, corporate structure engineered for laundering. And the last one was abuse of charities and EFG fronts. So using nonprofit and green organization to mask illicit financial flow. It was quite a long one even today, but if you found this video helpful, do press like and make sure to subscribe for more insight into regulatory compliance and financial crime. Thank you for watching, and I will see you in the next one.